Well, Amazon shares are sliding today in pre-market. You've got shares off nearly 9%. The e-commerce giant forecasting weaker than expected revenue growth. Cautious consumers trading down and spending less. To discuss what's next for Amazon, want to bring in Shweta Kajuria, Wolf Research Global Internet Managing Director. Shweta, it's great to have you here. So I think the real reason why we're seeing so much pressure here on Amazon is the spending plans and exactly what that looks like here for Amazon going forward. And this is very much being viewed maybe initially as a negative from Wall Street. I'm curious how you're looking at those spending plans and I guess ultimately how you think that should be read by the street at this point.
Sure. First of all, thanks for having me. We view it as a cautious read that it is clear that Amazon is seeing pressure from consumer on higher ticket items. They called it out. However, they've also been calling it out for several quarters in a row that consumers have been trading down and have been looking at lower ticket items. Our view, however, is twofold. One is that Amazon, as long as Amazon continues to gain share, even when the growth is slowing, that's still a positive because they don't control macro, but they can control their share gains. That's point one. And second is that they're enhancing their position to gain share by delivering items faster. And what that flywheel is doing for them is that more folks are buying lower ticket items, like they called out everyday essentials and non-discretionary items on their platform, which is driving purchase frequency and allowing them to gain greater share. So even in a down market, as long as they're gaining share and they're offering consumers opportunities to drive purchase frequency, if it's just macro, I think investors will give them a pass.
Shweta, I'll be the person that says it. AI for Amazon here. They talk about it within their AWS segment, and they ultimately kind of look at this across both generative AI and non-generative AI workloads here. Is the company meeting the mark in terms of what investors would be expecting for some of the investments that Amazon has made, the CapEx that a lot of the big tech companies have earmarked in order to make sure that they don't miss out on the wave of generative AI?
Well, it is a little too early to say. What they have clearly said is that they have seen a very strong uptick in demand for AI features from their enterprise customers. That is increasingly clear. They're also seeing an uptick in the demand for moving on-premise to off-premise, which is just the demand for cloud and the secular tailwinds behind them. What it seems that they are doing, and it's not just Amazon, to your point, it's including Meta and Google, is they're building ahead of any potential demand that they get, because they want to be ready and have that capacity ahead of demand to be competitive. And I think that without Andy Jassy actually saying this, my guess is that he would agree with Sundar Pichai, who said on the public call that they are okay with over-investing because they'll find use case for the capacity that they're building, but they think that under-investing and missing out on this opportunity could have greater negative implications for the business. And I think that most large cap, mega cap tech CEOs would probably agree with that.
Shweta, what do you think that tells us about the likely price action? Clearly, there has been a lot of optimism when you take a look at the year-to-date price gains in Amazon ahead of this report. When you take a look at the last year heading into this print, the pullback that we're seeing today, is that a bit overdone? And I guess, what are you expecting to see looking out here over the next 12 months?
Well, first of all, the pullback partly is also an expectations correction. Investors had pretty high bar in terms of the magnitude of the operating income beat that we may see in the second quarter, in addition to accelerating growth in AWS. This retail softness call out was unexpected negative, but we don't want to miss out on the fact that they did produce pretty good operating income beat, just not to the mark that expectations were with investors. So it's partly an expectations correction and partly caution on retail spend. Over the next 12 months, we are buyers here on the weakness because Amazon is a very good margin expansion retail leader, but also an AWS leader story with a very strong advertising growth rate that grew in the high teens growth rate with a video as a catalyst. And so over the next 12 months, valuation here, when we look at it against a Walmart or a Costco even, is not demanding at all. They continue to do really well, and we do see long runway for growth on operating margins for both AWS as well as retail. So we'd be buyers here on the weakness.